Hi, what's going on, folks? Hope you guys are well today. Welcome to the YouTube video. So in today's video, I just wanted to talk to you about a couple of things. I wanted to talk about levels, price levels in particular, and about a variety of ways that, traders might use to put in price levels. And I want to talk about the relationship between important price levels versus less important price levels, and how do we determine what is an important price level. So let's get into it, guys. If you're new to the channel, hit the like button. That's the thumbs up thing. If you landed on this video and you don't know what you're doing here, well, you pretty much have two options. Either one, you stay, or two, get out of here. Just kidding. So basically, the concept is, how do we determine what an important price is in the market? Okay, a price that we should be watching when we trade there. All right, how do we determine that? There's many different practices of technical analysis that people use to determine probability of the market going higher or lower. I'll say right away that the one way that I have found that is the most logical is basically using something called market profile, and essentially the number one thing, which is volume at price. If you look at the right side of my screen, you can see that that is exactly that, volume at price. I also want to discuss briefly about some other ways that traders might be looking at market structure that is kind of in a way deceiving. Okay, so let's say, for example, we don't look at volume at price. Let's take it off of our charts. So I've zoomed in to a shorter term time frame just to give you a practical example of what it is I'm talking about. So generally what happens is this. There is a practice of technical analysis out there. I guess I don't know what it's specifically called, but it generally gets traders focusing on areas like the low of the day, the high of the day, the high of the previous day, low of the previous day. All right, that type of stuff. Now, the reason why this is arbitrary is just because the market trades above a high doesn't mean it's going to continue moving higher. It's very arbitrary in that sense. You're unable to see what kind of trading actually took place at those prices, were those prices even traded in the first place. So what makes that high or low have relevance in the market or not? Okay, the market opens and we move higher, fine, and then we start to kind of develop this sort of higher low pattern here, and you can kind of see this idea. Now, the majority of traders, again, not putting in a volume at price at all here, I'm not seeing where traders are doing business really. All I'm seeing if there was high volume or low volume, and I'm seeing this sort of pattern occur. So there's some higher lows occurring here, and basically it's telling me that the market is moving higher, therefore I should be looking to buy pullbacks. Now, the problem with this is that when the market moves lower a third or fourth time here, the natural instinct of traders essentially is to buy, because of the fact that we've been doing that previously, right? Because we're using these higher lows, this moving average, as a reference point. You can see here that we pretty much tag the low as a double bottom, and then we move higher. So traders are bullish. If you are unable to see the problem with this right now, then it means you don't have enough experience looking at price action. The problem with this is that this right here is a very obvious low, okay? Traders who are looking at this market from an unbiased perspective will clearly see that a lot of traders will enter this market based on this being a so-called double bottom. So what ends up happening is the sellers enter, and what's really interesting is that when they enter, you can see that these 5-minute bars, we just kind of one time frame our way all the way down and break the low. Quite interesting, isn't it? The bulls were in fact convinced that this was going to be our new higher low and that we were going for a new high, clearly. But in fact, that wasn't the case. Why not? How could we have determined this in any way, shape, or form? Well, using volume at price is one of those ways. The point of this video I want to basically get across to you, a lot of traders are looking at levels and categorizing them as support or resistance. All right, so let's just kind of go through a few charts here. I'll just look at a chart like Amazon, okay? And you can clearly look at this chart and say, okay, the bulls are in control as long as we hold, 28.69. But in reality, you're not basing that off of anything. You're just basing that off of this low point. This low point here, you're saying that if the market trades down to this low point, it's support. And if the market trades up to this high point, it's resistance. But in reality, you're not basing that off of anything. You're not actually looking at the volume that was traded at these prices in the past in relationship to the volume that's trading at the current prices now. So what I'm trying to say is that when traders look at levels like this and say, this is support, this is support, this is support, we're making higher lows, so therefore the market's bullish. Or in this case, this is resistance, the market moves higher, I need to sell it because this is resistance. That is completely arbitrary. It is based on nothing of reality, simply because you're not actually looking at what business was conducted at these prices to tell you that it's resistance or support. What business is being conducted now telling us that we are likely to move in a certain direction based on the business that has been occurring right now. So that's sort of what I was trying to establish in the first part of this video. Now, the next thing I want to talk about is how do we filter out important prices versus lesser important prices using volume at price. All right, so let's go ahead and put our volume at price back. You know, it's called a volume profile. That's the fancy way, but really it's just volume at price. So you can go ahead and get rid of traditional volume because all it really tells you if volume is high or low. In regards to price movements, that's arbitrary because what we care about is where the price is trading a lot of volume and where the price is trading not a lot of volume. It can be said that when the market is entering a place where it's trading a lot of volume, it's likely going to move away from that area into an area of lower volume and then potentially return to that higher volume area in the future. And this is just a simple auctioning pattern that happens in pretty much any price action, that is. Okay, so we're going to look at some 30-minute bars here just for fun, and we're going to just look at volume at price in session profiles and volume at price on our total profile. And I want to give you a basic idea of things you can use to prioritize certain prices over others, okay? The first thing I'm gonna say is looking at a session profile, okay? The session profile is very valuable because it gives us the cumulative volume that has taken place over the course of the entire session. We're seeing where our high volume and low volume areas clearly are on our session. So areas of high volume are generally considered to be important prices. They call it a point of control. So when we see a price that has a high amount of volume, that is considered a relatively important price zone, a price area. These are signals that are generated only by the market, okay? Now, in regards to single prints, you can also have lesser important single prints. Like for example, on a session basis, if you get a breakout above a high and it does leave a single print on a 15-minute footprint, for example, I would consider that, and again, it depends on the context. There are certain contexts where it could be considered a weak single. So the difference between a strong single and a weak single is like if it's a strong breakout out of an important market structure and we didn't look back to test that price ever since it broke out. That's an example of a strong single. Tongue twister. A weaker single would be like a breakout within the day session, but you're not necessarily breaking out above or below a key market structure. So that's a decent way of explaining the difference between a strong single print and a weak single print. And that makes a big difference. But again, guys, this is YouTube. I'm not gonna go so deep here, but we'll do our best. Let's continue on this journey a little bit here. What could often happen is that you'll get an idea about a price, and this price is considered to be a relevant price. But based on the new auctioning activity of the market, this price is now becoming less and less significant. Now, I've seen this on an intraday basis, and I can't really find an example for you right now on this 30-minute chart. It would be an example like the market is auctioning around a certain point and we have a clear high volume area and a clear low volume area, and now we start to have another high volume area developing. And what ends up happening is that old high volume area is still there, but it's less relevant in relationship to what's going on right now in the price action. So this is something that sort of requires practice. It is discretionary, but it's being able to determine when a price is more relevant than another price. So one thing that can confuse a lot of traders is when they're looking for one thing to happen. Let's say that they're leaning on a high volume area, for example, and they are long and they're right on the trade for a certain amount of time. But now it comes back to that point of control that they were leaning on, for example. And what they're failing to realize is that while the auctioning activity moved away from their entry price, something else happened and there was more volume that was developed at a different price. And it basically indicated that it was likely to come back and test that previous volume area and potentially even break right through it and go for a new area, because there might have been a lower volume area on the other side of that high volume area that hadn't been traded earlier. But because you were so focused on the previous price, you were not paying attention to the development of the new prices. So that's sort of how I can explain it to you guys. And again, I'm lacking a practical example in the market, but it happens all the time. It's when you're paying attention to a certain price too much that you get distracted from what's actually happening in the auction right now. All right, guys, so I will leave you with that today. I hope you enjoyed the video. Don't forget to subscribe, and I'll catch you soon. Take care. Bye.